Michael Ingram joining us now, market strategist. Michael, good afternoon to you from where we're sitting. Definitely not afternoon for you yet, it's morning. But how are you looking at all the developments you would have seen overnight? Things seem to be escalating very, very quickly, and we don't yet know what the retaliation, if any, from Iran on Israel is going to look like, isn't it?
Yes, indeed. And I would point out that equity markets were actually in quite a vulnerable position prior to these Israeli airstrikes. We'd seen global equity indices make up most, if not all, of the losses that they had initially incurred in the so-called Liberation Day tariff disputes. There were moves perhaps to resolve the situation with China. So, you know, the equity markets were waiting to be slapped down. And of course, what's happened overnight has given the perfect catalyst for that. So no surprising that you've seen stock markets actually taking a bit of a hit. I would suggest that actually the price action we've seen such far is actually quite modest. And then again, you got, you know, on the flip side of that, in a classic risk-off move, you've seen gold move higher above $3,400 per ounce. So yeah, we're all on tenterhooks at the moment. I think one thing to look forward to perhaps is that there was a scheduled meeting between US Special Envoy and the Iranian foreign minister scheduled for Sunday. Be very interested to see if that actually takes place. I'm pretty sure in any event that the Iranians are not going to sit on their hands and lick their wounds. These were massive strikes overnight, and they're going to retaliate.
Michael, very correctly put, right? There were massive strikes. Sorry, Harsh here. So there were massive strikes, and likely you will see a reaction. Our markets, the move hasn't been as strong as one would anticipate, given the way in which the situation is escalating and fast escalating. Do you expect there to be an accentuated move on markets, maybe over the next 12 hours at least, into the weekend?
Yeah, I think they're quite vulnerable. I think one of the challenges, ongoing challenges that multi-asset managers have been having really for the last year or so is they would actually quite like to be going into bond markets, but you know, inflation has been sticky globally. I know the last set of inflation numbers out of the US were relatively benign, but certainly expectations have moved a long way over the last year or so in terms of, for instance, what the Fed is going to be doing, faced with this sort of inflation profile. So to some extent, if you're running a multi-asset portfolio, you're kind of stuck in equity. Now, you have seen a rotation, certainly this year, from US equity, which was a default overweight position, into certain European markets. You've recently seen the DAX in Germany, for instance, reach new highs. But that seems to have kind of run its course at this point. The growth outlook in Europe isn't very good either. So, you know, where do you go? A bit of it can go into gold. You know, we've seen gold reach successive new time high, but the amount of money you can physically put into that asset is actually quite limited. So, you know, as I say, unless you want to throw your hands up in the air and admit you've got no investment ideas left and you put it all into cash, which, let's be honest, the investment managers are never going to do, you're in a bit of a quandary.
When you look at this kind of a risk-off mode, do emerging markets and the idea of emerging markets sort of fly out of the window? How do you see it, Michael? And especially from an Indian markets perspective.
Yeah, I mean, theoretically you should, but I mean, reviewing the performance of emerging markets, you know, thus far this year, they've actually been incredibly resilient. Now, some of this might be due to the fact that they've taken a bit of a beating and been serial underperformers in recent years. So there's a certain amount of catch-up going on. And the move that I mentioned, the rotation into Europe, I mean, I think, you know, emerging markets, certainly inflows, have been a net beneficiary of that. The other thing which I think has mitigated any contagion effect into emerging markets has been the price action on the dollar. And the dollar's down about 10% this year on the dollar index. So this classic risk-off move where you see the dollar rise and then emerging markets getting hit and probably having to effectively import more unhelpful US interest rate policy. That linkage hasn't been there this year. The dollar has remained weak. It may get weaker still. So they're kind of off the hook. But let's be clear. We're not talking about vast flows. It doesn't take that many certainly institutional, international investors to change their minds for the performance to actually reverse. But thus far, it's held up quite well.
Michael, just trying to play a devil's advocate here. One, you have the US which is itching to cut rates. Two, you have Donald Trump, who wants peace in the world, or is preaching peace to the world. And three, we can ill afford major escalations globally at this point, all of which point to the fact that likely this situation might well get doused quicker than what most are anticipating. Could this well be a time to go contra?
It's possible. I mean, you say that the US is itching for interest rate cuts. I think certainly the Trump administration is itching for interest rate cuts. And obviously, they have spent much of this year berating the Fed for not being quicker to cut rates. But if you look at what the market is thinking at the moment in terms of what the Fed is likely to do, maybe a quarter point cut in September and a further quarter point cut in December of this year. Now, these are cuts which the market had been penciling well over a year ago. We didn't get as many cuts last year, so I think there's a question mark as to what extent there is effectively a Fed put on risk assets. In terms of, and again, if you go into in terms of the ongoing diplomacy in various areas of the world, well, I think it's quite clear that the Israelis went ahead with these strikes with the knowledge, but not with the approval of, I think, the United States. Trump had been trying a diplomatic route. Clearly, that is out of the window at the moment. And if we move closer to where I'm sitting in Europe, what's going on in Russia, Ukraine? Russia is continuing to attack Ukraine. It's continuing to come up with excuses. So there's a very real risk that Trump is either going to walk away from that situation completely and just say, this is Europe's problem, or he might go the other way and decide that he's going to, increase aid to Ukraine and prolong the war. But neither, I would suggest, is going to be an option which is likely to decrease geopolitical risk. So yes, I can see. I mean, we all like playing devil's advocate because it makes for interesting discussion points. But I think on the balance of probabilities, and given where risk assets have come, how equity markets have recovered this year, I still feel on balance that the risks are probably lie to the downside. But make no mistake, we're going to be tested in that over the coming days, because I would expect an Iranian response in fairly short order.
All right, thank you so much, Michael. This is a wait and watch situation. Let's be very, very clear about that. We do not know what's going to happen next, but this is something which will impact global markets as well.